Welcome to an emergency Friday evening episode of Crypto Macro Insights. I'm Maya, and it's Friday, September 5th, 2025, 6 p.m. Eastern. Tom, what we predicted yesterday has happened, but in ways that exceed even our most aggressive forecasts. Non-farm payrolls delivered a catastrophic 22,000 jobs versus the 160,000 consensus we discussed 24 hours ago. That's not just a miss, that's a 86% collapse below expectations. Meanwhile, overnight reverse repos hit an absolutely stunning $20.13 billion, continuing the historic collapse we've been tracking. Bitcoin initially spiked to 114,200 on the NFP release, then settled back to 110,797. But Tom, with the Fed now essentially forced into emergency accommodation mode, are we witnessing the beginning of the most explosive liquidity-driven crypto rally in market history?
Maya, I've been trading macro for 15 years, and I've never seen such a spectacular validation of a liquidity thesis in real time. Yesterday, we said weak NFP below 140,000 would confirm Fed accommodation. We got 22,000. That's not accommodation. That's emergency intervention territory. The BLS even had technical difficulties with their website, which tells you how shocked they were by their own data. Manufacturing down 12,000, with 78,000 jobs lost over the year. This isn't cyclical softening. This is structural collapse. Bitcoin spiked to 114,200 with institutions immediately repositioning for what they know is coming. The most aggressive Fed easing cycle since 2008. The fact that we've settled back to 110,797 isn't weakness. It's consolidation before the real move. With reverse repos now at $20.13 billion and the labor market in free fall, we're not just looking at 25 basis points on September 17th. Emergency 50 basis point cuts are now on the table.
The reverse repo data you're referencing is absolutely extraordinary. We tracked it falling from $21.07 billion just 3 days ago to $17.92 billion yesterday, and now $20.13 billion today. Tom, that's not the steady decline we expected, that's violent volatility as money managers scramble to deploy the final reserves. With this NFP catastrophe, how quickly could we see the facility hit zero?
Maya, what we're seeing is panic deployment of the final $20 billion. Yesterday's spike back to $20.13 billion from $17.92 billion represents institutions temporarily parking money overnight while they figure out deployment strategies after the NFP shock. But this is the endgame. Money managers can't sit on 4.3% reverse repo returns when they know emergency Fed cuts are coming and risk assets are about to explode. I expect violent swings over the next week as the final $20 billion gets deployed, but the directional bias is clear. We're going to zero within 10 trading days. That represents the final $20 billion of forced liquidity injection on top of the $300 billion already deployed since March. Maya, we're witnessing the conclusion of the biggest peacetime liquidity event in Federal Reserve history, and it's happening exactly as the labor market collapses. This isn't coincidence. It's perfect storm conditions for the most explosive asset price inflation we've ever documented.
Speaking of Fed response, the market is now pricing 75% probability of a 50 basis point cut on September 17th, up from 25% just yesterday. Powell can't possibly stick to 25 basis points after this NFP disaster. How does this change the entire accommodation timeline we've been discussing?
Maya, everything is now accelerated. We were discussing gradual accommodation through Q4 2025. Now we're looking at emergency intervention within 12 days. 50 basis points on September 17th is the minimum response to 22,000 jobs. If continuing claims spike next week, or if we get more labor market deterioration, emergency intermeeting cuts become probable. The Fed has lost control of the narrative. They can't pretend this is data-dependent policy when the data is screaming economic emergency. This actually creates the perfect cover for them to unleash maximum accommodation while appearing reactive rather than proactive. Powell gets to be the hero responding to crisis rather than the architect of bubble inflation. Politically brilliant, economically terrifying. Bitcoin benefits massively either way because emergency Fed accommodation plus forced reverse repo liquidation equals parabolic asset price inflation.
What's absolutely stunning is that despite this NFP catastrophe and Bitcoin's spike to 114,200, social media sentiment remains genuinely pessimistic. The 4chan discussions we monitor show people expecting crashes, rotating to gold, predicting economic apocalypse. Tom, this contrarian setup is now at historic extremes. How much longer can this sentiment divergence persist?
Maya, we're witnessing the most extreme contrarian indicator in modern financial history. Retail sentiment remains at maximum pessimism exactly as the biggest liquidity injection since 2008 reaches its climax. The 4chan discussions you mention are fascinating. People genuinely convinced that Red September is delivering crashes while institutions quietly absorb every share between 108,000 and 112,000. This divergence can't persist much longer because the liquidity mathematics are overwhelming. When the final 20 billion leaves reverse repos and emergency Fed cuts begin, sentiment will flip violently. But that flip will come too late for retail to benefit. By then, Bitcoin will be trading 125,000 to 135,000, and the contrarian opportunity will be exhausted. We're in the final days of maximum pessimism coinciding with maximum liquidity injection. This is the setup of a generation.
Given today's NFP validation of our thesis, how are you adjusting the position framework we discussed yesterday? You mentioned potential 2% tactical adds based on NFP reaction. Are you implementing that now?
Maya, I'm implementing the 2% tactical add immediately. Bitcoins hold above 110,000 after the initial spike to 114,200 confirms the liquidity thesis is stronger than any economic data. My framework is now 5% core allocation maintained with stops at 108,000, plus 2% tactical allocation added today with stops at 109,000. If we break above 115,000 within the next week, which I expect as the final reverse repo liquidation accelerates, I'll add another 1% with stops at 112,000. This gives me 8% maximum allocation with layered stops to protect capital while capturing what could be the biggest liquidity-driven move in crypto history. The key insight is that we're no longer trading Bitcoin fundamentals or technicals. We're trading Federal Reserve balance sheet dynamics and forced institutional deployment of 320 billion in excess liquidity.
As we head into the weekend with this NFP shock still reverberating, what should our listeners watch for? The reverse repo data updates Monday, we have continuing claims Thursday, and then the crucial September 17th FOMC meeting. How do you see the next 2 weeks unfolding?
Maya, the next 2 weeks will be historic. Monday's reverse repo data is critical. If we see continued violent swings as the final 20 billion gets deployed, it confirms institutions are in panic accumulation mode. Wednesday's continuing claims could be the final nail. If unemployment spikes, emergency intermeeting cuts become probable. September 17th FOMC is no longer about 25 versus 50 basis points. It's about whether Powell acknowledges we're in emergency territory requiring 75 basis points or coordinated global intervention. Bitcoin's reaction will be immediate and violent. Any break above 115,000 targets 125,000 to 135,000 within days, not weeks. The liquidity mathematics are overwhelming. 320 billion in forced deployment plus emergency Fed accommodation equals the biggest asset price inflation event since the 1970s. Retail will chase at 130,000 what they refuse to buy at 110,000. Classic bubble dynamics accelerated by unprecedented liquidity injection.
Tom, we've been covering this reverse repo collapse and liquidity thesis for months, but today feels like the moment when everything converged: catastrophic employment data, accelerating repo liquidation, forced Fed accommodation, and maximum contrarian sentiment. Are we witnessing one of those rare moments that gets remembered as a market inflection point?
Maya, September 5th, 2025 will be remembered as the day the biggest peacetime liquidity injection in Fed history collided with economic reality. The 22,000 NFP print wasn't just bad data. It was the moment the Fed lost all pretense of gradual, measured policy response. When historians look back at crypto's transition from speculative asset to institutional treasury reserve, they'll point to today as the inflection point. We have $320 billion in forced liquidity deployment, emergency Fed accommodation incoming, retail sentiment at maximum pessimism, and Bitcoin demonstrating perfect institutional accumulation patterns. This isn't just a great trading setup. It's a once-in-a-decade confluence of monetary policy, market structure, and sentiment extremes. The only comparable moment was March 2020, but that was crisis-driven. This is different. This is the Fed engineering the biggest asset price inflation in modern history while maintaining the fiction of data-dependent policy.
Extraordinary analysis, Tom. To summarize this historic day for our listeners, NFP delivered catastrophic 22,000 jobs versus 160,000 expected, an 86% collapse below consensus that forces emergency Fed intervention. Reverse repos remain volatile around $20 billion as final liquidity gets deployed, down from $135 billion in March, representing $320 billion in forced institutional deployment. Bitcoin spiked to 114,200 on NFP release, settled at 110,797, confirming institutional accumulation ahead of emergency accommodation. Fed now forced into 50 basis point minimum cuts September 17, with intermeeting emergency cuts probable if data deteriorates further. Updated position framework, 5% core plus 2% tactical add implemented today, potential 8% maximum allocation with layered stops. Key levels, 115,000 break targets, 125,000 to 135,000 within days. Retail sentiment remains at historic pessimistic extremes despite the most bullish macro setup in crypto history. This is no longer gradual accommodation, this is emergency intervention coinciding with the biggest peacetime liquidity injection in Fed history. September 5, 2025 will be remembered as the day everything changed, when the most extreme contrarian setup met the most extreme liquidity injection in modern markets. The next 2 weeks will be historic. Position accordingly, stay disciplined, and prepare for what may be crypto's most explosive institutional adoption phase. We'll continue real-time coverage as this unprecedented situation unfolds.